This is Nightly Business Report with Bill Griffith and Sue Herrera.
Fear of missing out. The stock market is having its best start to a year in decades. But don't sweat it if you missed it.
Hands-on healthcare. Your local drugstore may soon get a makeover, making it less like a retailer and more like a wellness center.
Deep in debt, the U.S. government owes a record amount of money, as do American households. Those stories and more tonight on Nightly Business Report for Wednesday, February 13th.
And we do bid you a good evening, everybody, and welcome. Yesterday's rally in the stock market continued today as Wall Street still monitors the progress of the spending bill in Washington designed to prevent another government shutdown and those trade talks taking place in Beijing. The sense is that if a deal is reached between the U.S. and China without any more tariff increases, that would reduce concerns about growth and perhaps allow the rally to continue, which it did today. The Dow gained about 117 points, back to 25,543. The Nasdaq was up 5, and the S&P gained 8. And we'll have more on the U.S.-China trade talks in just a moment. But we begin tonight with a closer look at the sharp market rally that we have seen so far in 2019, at how far the major indexes have come in such a short period of time. Just since the lows of December 24th, the Dow and the S&P are up nearly 14%. The Nasdaq has gained roughly 17%.
And that is leading some to fear that they've missed out on the rally. But did they? Jeremy Siegel, finance professor at the University of Pennsylvania's Wharton School of Business, joins us now to talk about that. Good to see you, Jeremy, as always. So
Happy to be here, Sue.
I guess that is the question. Have they missed out? What are your expectations as we go further into this year?
Well, certainly you missed out. There was an incredible Christmas Eve sale on December 24th. I think we all wish, oh my God, we could have gotten these great bargains. I think we've seen, as you said, 15, 16%. I mean, we've seen a big increase since then. I think most of the increase is behind us now. I do think we're going to have an upward tilt to the end of the year, but it's not going to be a runaway. I don't think, people say, oh my God, I got to get in. Otherwise, I'm going to miss a big rally.
I think it was John Templeton who said, you're never going to sell the absolute top of a market. You're never going to buy the absolute bottom of a market. You might as well just stay in the market, and it eliminates this fear of missing out. What do you think about that?
Oh, I've been advocating that for years. If we let our emotions take hold of us, we're going to all sell at the bottom, and we're all going to buy at the top, which, of course, is exactly opposite of what you want to do. Plan long term. And by the way, I think long-term values are there. This market is certainly not as undervalued as it was last December, but it isn't overvalued. So certainly don't shy away from the market as a result of this rally. But I don't think you have to go, head over tail in and say, oh, my God, it's going to be up another 10, 15, 20%. Because I think it has struggles ahead. This year's earnings are certainly not going to be anything like last year's. And we still have, of course, the trade and, political considerations coming in front of us.
And that headline risk could create a lot of volatility. We've already seen that happen, but we're coming up once again against another deadline, and the trade talks are inching closer to an agreement, but we certainly aren't there yet.
Yeah, and I think the market is 90% certain that there's going to be an agreement, and I think they're right, which means if we get one, we'll see a pop, but it won't be an enormous pop. I expect maybe a 5-6 point rally in a few days, and then it's going to have to contend with a lot of other worries into the market. In other words, it would be very shocked if Trump imposes 25% tariffs and we head into a trade war. I'm afraid we're going to see a bear market, but we will see a pop on a settlement. Of course, we also have to expect that Trump has talked about maybe we're going to delay the March 1st deadline, so we have to be prepared for that.
Right.
A pop, but not a huge upward surge.
And on that note, Jeremy Siegel, thank you so much. Jeremy's with the Wharton School of Business.
Now to the trade talks, and today there were encouraging signals from both sides about the negotiations. Back we go to Eunice Yoon in Beijing tonight.
The The South China Morning Post, a Hong Kong newspaper, is quoting sources as saying that President Xi Jinping plans to meet with Treasury Secretary Steven Mnuchin and Trade Representative Robert Lighthizer possibly Friday as a goodwill gesture for the trade talks. Mnuchin and Lighthizer are here to meet with the Chinese Vice Premier on Thursday and Friday. And today, Mnuchin told reporters that he hoped that the conversations would be productive. The Wall Street Journal is reporting that the negotiators are focused on drafting a framework of an agreement that can be signed by Presidents Trump and Xi at a possible summit, though it's still unclear how much the two sides can narrow their differences. The markets here rallied on news that President Trump was open to extending the March 1st deadline. The Chinese side would likely welcome an extension, since Trump administration officials have said in the past that the March 1st deadline was a hard deadline. Without that pressure, the Chinese would be able to keep on talking, and some American business people would argue without taking much action. For Nightly Business Report, I'm Eunice Yoon in Beijing.
And now to Brexit, which many economists and strategists consider a potential threat to global growth. Ford reportedly told the British Prime Minister that it may have to move some production out of the UK if a deal is not reached that would provide Britain with a smooth exit from the European Union. And with the deadline to reach a deal fast approaching, Willem Marx is in London, and he takes a look at where things stand.
For British Prime Minister Theresa May, time and Parliament repeatedly prove to be part of the same paradoxical equation. The less time she has, the more challenges Parliament provides, with an exponentially increasing threat from allies and enemies alike.
The government's handling of Brexit has been costly, shambolic and deliberately evasive.
There now remains slightly more than 6 weeks until Britain hits a 2-year deadline designated for its departure from Europe. And the Prime Minister's critics claim she wants to use that hard out as a pressure tactic, both at home and abroad. It was a month ago that May suffered a crushing House of Commons defeat.
So the noes have it, the noes have it.
But the factional complexities that currently course through this country's political veins have continued to function as a form of life support, at least until now.
After another 2 weeks of talks here in Westminster, in Brussels, in Belfast and in Dublin, the Prime Minister has acknowledged she needs yet more time to find a negotiating breakthrough. That apparent lack of progress has once more prompted a barrage of criticisms and accusations from her political opponents.
This is the height of arrogance from a government set on running the clock down. Just 44 days from a no-deal scenario, the Prime Minister is hung-strung by her own party and rejected by European leaders.
But her approach with the Europeans does have some support.
They said they'd been waiting for months for a determined view from London. They got that determined view. I think Theresa May has rightly asked for some more time to see if she can get a deal with Brussels.
So far, though, Brussels refuses to budge from a position it first took up many, many months ago. Tomorrow will bring yet another day of Brexit debate and voting. And in a sign of the mathematical conundrums May faces, some of her fellow Conservatives are again threatening to rebel against their leader. For Nightly Business Report, I'm Willem Marx in London.
Back here, Dow component Cisco reported better than expected results today thanks to its application software and cybersecurity businesses. The company said it earned 73 cents a share. That was 1 cent better than estimates. Revenue rose from a year ago to more than $12 billion. Cisco also increased its dividend, and investors obviously liked what they saw, sending the stock higher in initial after-hours trading.
This earnings season is in the home stretch, and so far, so good. Mostly. Dominic Chu explains.
It's almost over. Nearly 3/4 of all S&P 500 companies have reported their results so far, and so far, it's been a generally good story. According to data from Refinitiv, 71% of companies have beaten average analyst estimates for earnings, and 62% have beaten the average revenue estimate from analysts as well. That has some experts feeling good about the health of corporate America.
We're predicting that growth to be at least 2.5%, which I think is a little better than most. I think people are going to be surprised.
If every company left reports earnings in line with analyst expectations, the S&P 500 will see nearly 17% earnings growth and around 6% revenue growth. That's the good news. The bad news is last quarter was so good, it'll be tough to top this year.
I think we'll have negative year-over-year earnings growth. Now, part of that's a little bit unfair because we had the, steroid-induced year last year, which was crazy because of tax reform.
We're already seeing some signs of increasing pessimism. In October of last year, Wall Street analysts were predicting that earnings growth in the first quarter of 2019 would be solidly positive. Fast forward to today, and those same analysts are predicting a slight earnings decline. It could make for a more volatile market when the next earnings season kicks off in mid-April. For Nightly Business Report, I'm Dominic Chu.
Time to take a look at some of today's upgrades and downgrades. Freeport-McMoRan was upgraded to overweight from equal weight at Morgan Stanley, with the analyst citing an improved outlook for copper prices. Price target is now $14, and that stock rose nearly 7% today to $12.29. Lattice Semiconductor was upgraded to positive from neutral at Susquehanna. The analyst cited the company's better-than-expected quarterly guidance, which it issued last night, and it ran counter to the weaker environment we've been seeing for semiconductor stocks more generally. Price target now for Lattice, $11. That stock rose 29% today to $10.60.
Still ahead, hitting the gas.
Why is BMW gearing up for a big 2019? I'm Phil LeBeau in Thermal, California. That story coming up on Nightly Business Report.
Johnson & Johnson is buying Auris Health for about $3.5 billion. The acquisition pushes J&J further into the healthcare robotics market. Auris's flagship product is a robot used by surgeons remotely. Auris's focus is on lung cancer and respiratory procedures. Shares of J&J rose in today's session.
Well, CVS is now starting to use its merger with Aetna to try and change the definition of a drugstore. The company is turning some of its locations into what it now calls health hubs, offering more services and health-focused products. Bertha Coombs takes us to one in Spring, Texas tonight.
More than half of the new CVS Health Hub concept store is devoted to health care, with more space for Minute Clinic services and medical merchandise like walkers, as well as a wellness studio, where customers like Jacqueline Haynes come in for yoga classes and get one-on-one advice on managing their health.
They also have a program where they have a dietitian. I think the dietitian would meet with you for free, and so she's teaching me about my blood pressure, because I do have hypertension.
Along with a dietitian, the Health Hub has a respiratory therapist and new products to treat sleep apnea, a breathing disorder that can lead to other health issues.
Sleep apnea is one of the least or most undiagnosed opportunities, and so by having a respiratory therapist and the nurse practitioners collaborate, we can both screen and then provide and fit masks and machines and teach people how to use them. So kind of closing that loop around a condition that a lot of Americans have.
CVS isn't the only one experimenting with hands-on health care. Some of their large insurance rivals like Cigna, United Health, and Humana have programs where they reach out over the phone to members who have hypertension or diabetes to try to get them to help manage their care, or send in help at home after a patient has been discharged from the hospital, sometimes in conjunction with Walgreens on some programs. But CVS is trying to bring all of those services together under one umbrella. Here at its new Health Hub, CVS is reaching out to its insured Aetna members with diabetes, hypertension, and heart disease to come into the store for health coaching services.
We've been pleasantly surprised at how many of our pharmacy customers, when offered the dietitian services, have said yes.
In the first month, more than half, like Jacqueline, have acted on new health changes.
It's one-stop shopping for my health.
The yoga classes and initial consultations are free, but diagnostic services and medical equipment are billed through insurance or paid out of pocket. Executives admit it's early days, and they are trying to figure out just how to get the mix right. For Nightly Business Report, I'm Bertha Coombs in Spring, Texas.
And to read more about CVS's Health Hubs and what others in the industry are doing, you can head to our website, read about it at nbr.com.
Hilton is raising prices, and that's where we begin tonight's market focus. The hotel operator is charging more for rooms, and that helped the company report better than expected quarterly profits. Hilton cited healthy demand for travel, though it did point to a possible deceleration in revenue growth per room this year due to concerns over global growth. Hilton shares were up just about 7% to $79.37. Dish Network missed earnings expectations, but revenue came in above forecasts. The satellite TV operator also lost more than 300,000 subscribers last quarter, thanks in part to carriage disputes with HBO and Univision. The number of subscribers fell below 10 million for the first time in 15 years. Shares plunged more than 7.5% to $28.86. Teva Pharmaceuticals posted weaker than expected fourth quarter earnings. The drug maker also issued disappointing full year guidance, citing competition from generic drugs for its blockbuster multiple sclerosis drug, Copaxone. Teva shares plummeted over 7.5% to $17.63.
T-Mobile and Sprint executives were on Capitol Hill today answering questions from lawmakers about their proposed $26 billion merger. The CEO of T-Mobile defended the get-together, saying it will not hurt consumers or jobs.
The outcome of this merger will be a significant increase in supply in the form of 8 times the capacity that our network will make available. It will bring an 87% decline in the price per gig of data, and jobs will go up. So this is dramatically different.
And shares of both companies fell a fraction in today's trading. And late today, AIG reported a quarterly loss, which was below the profit that analysts had been looking for. The company cited catastrophe losses along with volatility in both the equity and in the credit markets. AIG also announced, by the way, a $2 billion stock buyback program. Shares were initially lower in after-hours trading tonight, but they finished the regular session up a fraction at 44.18.
BMW plans to ramp up production at its Seoul, U.S. plant this year to keep up with America's growing appetite for luxury SUVs. In fact, the automaker expects to build a near-record number of vehicles, including its newest model, the X7. Phil LeBeau reports tonight from Thermal, California.
If bigger, more luxurious is better, this is the golden age of high-end SUVs. BMW's all-new X7 hits showrooms next month as the strong economy adds to the appeal of upscale SUVs.
If you look at the SUV market in total, SUV market is growing and growing and growing. On the premium side, it's now nearly 60% now.
Over the last 6 years, luxury SUV sales have steadily picked up speed, thanks in part to popular models like the Mercedes GLS. Meanwhile, newer, refreshed entries like the Lincoln Navigator will be added competition for BMW's biggest SUV.
When we're looking at the high end, the top end of the bandwidth, really that large 7-seater, there's really about 10 vehicles that this BMW X7 competes with. And it's become very competitive. Obviously, this is where a lot of profit margins are made, and I think that's why they're looking to enter the segment.
The X7 will be built at BMW's plant in South Carolina, where production is expected to climb this year to near record levels. For BMW and other European automakers, building popular SUVs here in the U.S. is critical to their success, especially as the White House considers slapping tariffs or higher costs on luxury sedans imported from plants in Europe, a move that would hurt sales.
Am I concerned about it? Yes, I am, because it will have an impact. If tariffs goes up, it's not good for the consumer, it's not good for our dealer network, it's not good for the economy in total.
Overall, Bernhard Kuhn believes America's appetite for new vehicles remains strong. Welcome news with the X7 rolling into showrooms next month, entering a crowded luxury SUV market where buyers are willing to pay more than $50,000 for a new ride. Phil LeBeau, Nightly Business Report, Thermal, California.
And those higher prices means that Americans are taking out bigger car loans. And speaking of which, the word debt was very much in the news today. First, the Treasury Department said that our nation's federal debt level has now surpassed $22 trillion for the first time. Then the Federal Reserve Bank of New York reported that more than 7 million Americans are behind on their car payments by at least 90 days. Finally, a new survey from Bankrate.com found that roughly a third of Americans have more credit card debt than they do in savings. Joining us now to talk about the implications of all of this for the economy, Joe Brusuelas is back with us. He's chief economist at RSM. Joe, good to see you again. Welcome back.
Thank you.
Do any of those numbers make your palms sweat?
Well, the fact that we've got people falling more than 90 days behind on their loans for auto loans does cause some concern. I'm not too worried about the national debt. Right now, that's not a problem, nor should it be our concern.
But longer term, is it going to be an issue for the U.S., especially given the interest rate environment that we find ourselves in?
All right, so if we continue in this low interest rate environment, it's not going to be a real concern. We've learned a lot about debt and deficit dynamics over the past 30 years, primarily by watching what's happened in Japan. Now, we don't want to go there to around, we're going to be 200% of debt to GDP ratios. But should we see a resetting of interest rates back to what we might consider their natural level, then it would be a problem.
What about the metric that Bankrate talked about today, where a third of Americans have higher credit card debt than they do savings? I mean, it's happened in the past. This is how we get ourselves into trouble, with higher debt than we can manage. Are we there yet, do you think?
Well, there's two things. One, that's classic late cycle dynamics. Two, we've got two different economies here in this country. One's along the coast, aligned with tech, digital, scientific, literary, life sciences, and the other's more traditional. That's in that traditional economy. That's where the problem is, and that's where you see the middle class falling further behind. And of course, that stokes lots of social and policy tensions around the country.
If I can turn you back to the car loan issue, because it's essential for people to have transportation to work. So if indeed they are falling that far behind on their car loans, what are the implications for the economy? And also, some of these loans are not through traditional bank lending.
All right, so we're not going to have any financial systemic problems because of delinquencies. These are made by non-bank lenders. Two, over 25% of all the loans made during this business cycle have been subprime variety within the auto sector. So this isn't something that's largely going to be unexpected. But when you begin to see people fall behind like that, that's a sign that your economy is slowing. And we are slowing back to around 1.8%, which is a long-term trend, and that's where we'll be here in this year.
All right, we're not at a crisis, but it's something to keep an eye on. Joe Brusuelas from RSM, always good to see you. Thanks again for joining us tonight.
Thank you.
And coming up, farmers plow ahead despite facing challenges.
Oh, sure, at the farm show, it's all fun and games, but we're about a year into the trade and tariff war, and the question really is, for farmers and equipment makers, what's the real impact? Do they have a tough row to hoe? We'll have that coming up.
Here's what we're watching tomorrow. Retail sales for December will finally be released. It's a month late because of the partial government shutdown. The Producer Price Index will give investors a look at inflation pressures in the economy right now. And Dow component Coca-Cola releases its quarterly results. That's what we're watching for on Thursday.
Google plans to expand into Nevada, Ohio, Texas, and Nebraska, and it will spend $13 billion this year to do so. In a blog post, CEO Sundar Pichai said that the new locations will be both data centers and offices. This is the first time Google will have infrastructure locations in those states. The company is also doubling its workforce in Virginia and expanding its New York campus.
Well, it's certainly been quite a year for the agriculture industry. As we have been reporting, farmers across the country find themselves caught in the middle of the U.S.-China trade war, something that is both positive and negative. And as Jane Wells reports now, it was the big topic of conversation at this year's World Agriculture Expo in Tulare, California.
You guys have a good day. It is the largest farm show in the West. And it's a good place to take farming's financial temperature nearly a year into the trade and tariff wars.
The processors won't take any more milk. The beef's not worth as much as it used to be. So, yeah, it's been pretty tough.
Yep, large parts of the farm economy have taken a hit, but it's not all bad. Lower soybean exports mean more soybeans at home to feed American livestock.
So it's actually helped us a little bit on the input side.
Here in California, exports of fresh oranges have plummeted an estimated 80% because of Chinese tariffs, missing out on the popular Lunar New Year celebration. But that means cheaper prices for American consumers.
Orange prices are off 30–40% in recent weeks versus where they were at the same time last year.
So what does this mean for equipment makers? These machines cost more due to tariffs on imported steel. Yet U.S. tractor sales were up over 5% in January.
The decision that farmers have to make is after the buying boom in 2013 and 2014. This would be the time that they would start replacing equipment. Will they? Well, they're certainly here kicking the tires.
And honestly, the age of the U.S. and Canadian vehicle park, the age of the machinery on the farms, it's at a point where the farmer is needing to replace.
Even so, Deere was downgraded to neutral by Bank of America over concerns in part about trade. Yet once again, most farmers appear to be sticking by the president as he talks trade with China.
It does hurt, but I think in the end, when things play out, it'll be better for everybody. It had to be done. Things couldn't go on the way they were.
For Nightly Business Report, Jane Wells, Tulare, California.
And before we go, here's a look at the final numbers from Wall Street. The Dow rose 117 points, NASDAQ was up 5, and the S&P 500 gained 8. And that will do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.